Hi everyone, and thank you so much for watching my channel The Witty Turtle. In today's class we are going to start with another section. So before starting that, let's do a quick revision, or let's remind what did we study in the last class. So in the last class we basically studied one very important concept, that there are certain funds meant for the welfare of the employees, where the employer has to contribute some amount of money into that fund, and the employee also has to contribute some percentage of his salary into that fund. And after the maturity, or after the retirement, or even during his employment, the employee can take out money from that fund for his own usage, right? For the welfare of the employees these funds are made. So in the last class we studied that what happens when the employer contributes, so whether it is allowed or not. And in today's class we are going to study what happens when the employee contributes towards these kinds of funds, right? So in the first section that we are going to study now is your section 36 subsection 1, clause 5a. You don't really need to remember the clauses, simply 36(1) is fine. So this particular section says about employees contribution towards a recognized provident fund, that is your RPF, approved superannuation fund, and lastly any other fund under your ESI Act, that is your Employees State Insurance Act 1948, any other fund under your ESI Act. So this section basically says that any amount received by the employer, right? We studied that employee also contributes some amount of money into the fund, right? So this particularly says that any amount received by employer from the employee as a contribution towards PF, ESI or superannuation fund, so it is deemed to be treated as PGBP income of the employer, if the sum deposited in relevant fund after the due date of such fund, right? So here we are not talking about your section 43B, right? Here this section 43B is not at all applicable. So due date की जो बात हो रही है यहाँ पे, this due date means due date of that particular fund, okay? For better understanding, look at the screen and try to understand this particular example. So in this example, Mr. Hari is an employee of Tata Limited, okay, and the salary of Mr. Hari is 50,000 rupees per month. So out of the 50,000 rupees, Mr. Hari is contributing 6,000 per month into, let's say, ESI Act, a fund under your ESI Act, okay. So here what happens, the employee is contributing the money, and the employee is paying that money to the employer, right? And now it is the duty of the employer to deposit that amount in the relevant fund. So here what happens, for example, due date of that fund is 15th of April 2023. So in this case what happens, if the employer, that is your let's say X Limited, not taking any name, if the employer X Limited is unable to pay this 6,000 rupees in the relevant fund before the due date, that is before 15th of April 2023, then if he pays, then what happens, it is allowed as a deduction. But if the employer is not able to deposit that amount of money in the relevant fund before 15th of April, then what happens, that 6,000 will be treated as PGBP income in hands of X Limited, in hands of the employer, right? I hope this is clear. So look at the example. It says that due date is 15th of April, and the employer deposited the amount in the fund on 15th of May, exactly after 1 month. So here what happens, this 6,000 is, as this 6,000 is not deposited in the fund by 15th of April, so it will be treated as the income of the SSE, in the PGBP income of the SSE. But now another question arises here, is that what if the employer pays or the employer deposits the amount in the relevant fund after the due date in the next year? So when the employer will deposit that amount in that previous year, in the next previous year, the employer will get the deduction for that, right? I hope this is clear. Another point to remember is that it says that provided such sum is credited by the SSE to the employee's account in the relevant fund. Credited by the SSE का क्या मतलब होता है कि एम्प्लॉई से ले लिया है पैसा, they have taken the money from the employee but they have not deposited that in the relevant fund. Understood? If before, this is the due date, if before the due date they have deposited in the fund, then what happens in that case? Deduction will be allowed. But if after the due date they have deposited, then it will be treated as the PGBP income, right, in hands of the SSE. And in this case, provisions of section 43 shall not apply. And in this case, due date का मतलब क्या होता है? Due date of the respective funds. If that is that is supposed to be deposited in the ESI fund, then the due date of ESI fund will be applied here, right? I hope this is clear. Now coming to the next section, that is your section 36 subsection 1 clause 6. This speaks about animals used in business otherwise than as stock in trade, right? So this says that animals are being used in the business, but here trading of animals is not happening. The business is not of trading the animals, right? What can be the example of this kind of business where animals are used but you are not selling or buying the animals? The example can be of any kind of milk producing company like Amul, or any kind of poultry farm, right? So this can be the examples of businesses having animals but not as stock in trade. So this says that in this case where the animals either die or they become permanently useless for the business purpose, so in that case what happens? The difference between the actual cost of the animal to the SSE, actual cost minus whatever amount realized in respect of the death or selling of the animal after it becomes permanently useless, so that difference amount will be allowed as a deduction in the debit side of the P&L, right? So it says what? The difference between actual cost of the animals to the SSE and the amount realized in respect of animals or carcasses in as in dead bodies of the animals, right? So what can be the example in this case? Let's say I bought let's say the company has a poultry farm, and they bought one hen for rupees 10,000. Okay, let's say for 10,000, and after the death of the hen, or maybe after the hen becomes permanently useless for the business, it got sold at a price of 5,000, right? It got sold at a rate of 5,000. So in this case, 10,000 actual cost minus realized amount on selling, that is your 5,000, equals to 5,000. This 5,000 amount will be allowed as a deduction in the debit side of the P&L, right? I hope this is clear to you. So these two sections basically speak about this. I really hope this class has been a useful one to you, and if you find this video helpful, then please hit the like button, subscribe to my channel The Witty Turtle, and don't forget to hit the bell icon so that tomorrow you'll be notified when I'll upload a new revision class on PGBP. And yes, don't forget to share this video with your CA and CMA final friends.